Great to have you, Dave. Give us the bear case here that I don't know if the bear case would actually be bullish for the markets at this point or and vice versa, but tell us what you think is going on.
Well, look, I think that the labor market, for one thing, is a lagging indicator, and everybody focuses on the non-farm payroll headline, which, of course, came in above expectations. But the household survey was a big negative. It was the worst month for the rival household survey, which amazingly nobody talked about today since April of 2020. And so what I would say is that a couple of things on the employment side is that when you get this divergence between household and payrolls, it usually takes place at the tail end of the cycle. Usually the household survey, when it starts to go down, at a time when payrolls are going up. That's happened before, each of the last 4 recessions. So that's actually a divergence that you want to pay attention to. But look, I'll just go back to the most important thing that came out this week from that perspective, which was the ADP number, because the household survey, the payroll survey, they don't tell you what companies are doing according to size. And small companies are in the weeds when it comes to having a front window on the economy. And in the past 3 months, the small business sector has actually, on net, let go 105,000 people, Kelly. And that always happens at the peak of the economic expansion. The large companies, and there's a large company bias in the non-farm payroll survey.
Yeah.
The small companies are actually starting to let people go. And that is actually a phenomenal, albeit I'd say troublesome right now, leading indicator for the economy coming out of the jobs market that everybody seems to think is so red hot. And that's because they're not looking at the forest past the trees.
One of the things I think is going to be super annoying about the next 12 months is that we look like we could be headed for a recession, either because of the factors that you're seeing, already a loss of momentum, or in kind of the way that I've been looking at it is more because the Fed isn't tightening enough and they're going to have to slam on the brakes in the future. But my point is, if we get to a recession either way, it's almost like everyone's going to say, see, I was right. See, we were slowing. They shouldn't have tightened. See, they should have tightened more, and then we wouldn't have to slow this much. You know what I'm saying? I mean, this is going to it's going to be I think the markets are trying to even figure out what's up and what's down.
Well, it's because, this is the most complicated situation that we've ever seen in our lifetime. I mean, we have a shooting war in Europe coupled with an ongoing pandemic. And maybe in the U.S. and Canada, we're starting to live life again. But that's not the case in China, where they shut down, port cities with millions of people, it seems like every couple of weeks, which has a huge impact on global supply chains. So it's a very complicated situation right now. And so I'd say that, we got these exogenous price shocks. We can go back and talk about how strong demand is. It actually is not about how strong demand is. Real GDP, which is demand in the economy, people don't realize that when you look at the monthly GDP numbers, Kelly, they're running negative 2.4% from October to March. Like the recession is probably already starting. Now, I know that you show the chart of the 3-month, but the question is, the 3-month at some point will catch up to the Fed funds rate. I don't think that's a meaningful indicator. The meaningful indicators, if you're taking a look at what the cyclicals, the relative strength of the cyclical stocks in the S&P 500, they're telling you a very significant story that is not consistent with a bullish theme from a steep yield curve benchmark from the 3-month Treasury bill. But the bottom line here is that we have this massive exogenous price shock. It is no longer a demand story. That was the inflation last year. That was the demand story and the supply story. It's just that the supply curve globally continues to shift to the left. And now you've got central banks saying enough is enough. We are now going to start to have to offset that by shifting the demand curve to the left. And that's how you get the recession. And actually, I would say that most people calling for recession, well, they'll tell you, Kelly, it's a 35% chance. So that way, if we get it, well, I did say 35%, or they're saying it's next year's story. No. It's actually already in the data, especially if you look at real incomes that ultimately drive real spending. Real incomes in the United States, negative 7 of the past 8 months.
I'm just saying, if they tighten sooner, then real incomes wouldn't be as bad.
Well, that's what I mean. Well, no, I agree with that, Kelly. Look, you're caught between a rock and a hard place. If this was inflation,
we gotta go. Yeah.
Okay, it was inflation caused by demand. That'd be one thing. So you get the inflation shock, and now we're going to get the interest rate shock. Either way, we get a recession out of it.